Question 686. An exclusive listing is an agreement through which the seller promises to pay a commission regardless of who finds a buyer and the broker promises to make a sincere effort to find a buyer. In other words, a promise is made in exchange for a promise. This kind of contract is called A. Unilateral contract, B. Bilateral contract, C. Seller's contract, D. Buyer's contract. Correct answer is B. Bilateral contract. A unilateral contract involves a promise by one party in exchange for an action by the other party. The other party is not obligated to perform the action, but if they do, the promise becomes binding. In this scenario, the broker is promising effort, not just acting. While the listing agreement is with the seller, the term seller's contract doesn't describe the fundamental legal structure of the agreement, the exchange of promises. A buyer's contract, like a buyer-broker agreement, is a separate agreement between a buyer and a broker. A bilateral contract is an agreement where both parties make promises to each other. In the case of an exclusive listing agreement, 1. The seller promises to pay a commission regardless of who finds the buyer, including the seller themselves in some exclusive right to sell agreements. 2. The broker promises to make a sincere, diligent effort to find a buyer. This exchange of promises creates a binding obligation on both the seller and the broker. Question 687. Prepaid rental listing agents are required to do the following, except A. Return the client fee if no referrals are submitted within 5 days of the agreement's execution. B. Provide a contract and receipt for every potential tenant, promising the return of their fee if certain circumstances are met. C. Submit an account statement to the real estate commissioner on a quarterly basis. D. Refund any funds over $25 if a rental is not procured. Correct answer is C. Submit an account statement to the real estate commissioner on a quarterly basis. A PRLS helps people find rental properties, and they often charge a fee up front, prepaid. Because they handle these fees before a tenant finds a place, California law has specific rules to protect those seeking rentals. The question asks which of the listed actions is not something a PRLS is required to do. Here's a look at each option. A. Return the client fee if no referrals are submitted within 5 days of the agreement's execution. While a PRLS is expected to provide timely referrals, the law doesn't typically mandate a full refund just for not giving referrals within the first 5 days. Refunds are usually tied to whether or not the tenant actually finds a rental. B. Provide a contract and receipt for every potential tenant, promising the return of their fee if certain circumstances are met. This is a requirement. PRLS must have a written contract outlining the services, the term of the agreement, and the conditions under which the tenant can get a refund. They also must give a receipt for any fees paid. C. Submit an account statement to the real estate commissioner on a quarterly basis. This is not a standard requirement. PRLS must keep records of their business and how they handle client funds. And these records must be available for the real estate commissioner, now the Bureau of Real Estate Calbre or DRE, to inspect at any time. There isn't usually a requirement to proactively send in a quarterly account statement to the commissioner. Instead, they are expected to provide reports to their clients, the potential tenants, about how their funds are being used. D. Refund any funds over $25 if a rental is not procured. This is a requirement. California law limits the non-refundable fee a PRLS can keep if the tenant doesn't find a suitable rental through their services, often setting this limit around $25. Any amount paid above that must be refunded to the tenant. Therefore, the action that a prepaid rental listing agent is not typically required to do is to submit an account statement to the real estate commissioner on a quarterly basis. Their financial records must be available for inspection, and they should provide reports to their clients, but a routine quarterly submission to the commissioner is not usually mandated. Question 688. Which of the following is not an essential element of value? A. Utility. B. Expectation. C. Demand. D. Scarcity. Correct answer is B. Expectation. The essential elements of value in real estate are often remembered by the acronym DUST. 1. Demand. There must be a desire and ability to purchase or lease the property. 2. Utility. The property must be useful and satisfy a need or want. 3. Scarcity. The supply of the property must be limited relative to demand. 4. Transferability. The property must be able to be transferred from one owner to another with clear title. Expectation refers to the anticipated future benefits of owning the property. While anticipation influences value, it is not typically listed as one of the 4 essential elements of value itself. It's more of a principle that underlies value. Therefore, expectation is not typically considered one of the 4 essential elements of value in real estate. Question 689. For the purposes of income tax, an owner's investment in a property is called the A. Taxing benchmark. B. Basis. C. Standard. D. Undivided interest. Correct answer is B. Basis. While the basis serves as a reference point for calculating taxes, taxing benchmark is not the formal term. Standard is a general term and doesn't specifically refer to the owner's investment for tax purposes. Undivided interest refers to a type of ownership where multiple parties have a share in the entire property, not the owner's initial investment. In the context of income tax, an owner's investment in a property is referred to as their basis. The basis is essentially the original cost of the asset, adjusted for certain items such as improvements, depreciation, and other factors. It's used to determine the taxable gain or loss when the property is sold or otherwise disposed of. Question 690. A. An is a voluntary conveyance of the right to maintain land in its natural state. A. Conservation easement. B. Solar easement. C. Easement in gross. D. Zoning variance. Correct answer is A. Conservation easement. Conservation easement is indicated as the right answer, based on the question's reference to keeping land in its natural state. Solar easement grants the right to use a specific property for solar energy collection, not necessarily preserving the natural state. Easement in gross is a broader legal term referring to a non-possessory right to use another's property. A zoning variance is a permission granted by a local authority to deviate from existing zoning regulations for a particular property. A conservation easement is a legal agreement between a landowner and a qualified land trust or government agency. The landowner voluntarily agrees to restrict development or use of the land in a way that protects its natural heritage, scenic beauty, or ecological value. Through a conservation easement, the landowner retains ownership of the property but gives up the right to develop it in certain ways. Conservation easements are a valuable tool for land preservation and can offer tax benefits to the landowner. Question 691. A person operating a business on a property he is leasing holds A. Leasehold estate. B. Freehold estate. C. Less than freehold estate. D. Both A and C. Correct answer is D. Both A and C. A leasehold estate is the legal right granted to a tenant by a landlord to occupy and use a property for a specified period in exchange for rent. Since the person is leasing the property, they hold a leasehold estate. A leasehold estate is also known as a less than freehold estate. This is because the tenant does not own the property outright, they don't have a freehold interest. This is because the tenant does not own the property outright, they don't have a freehold interest. Their rights are limited by the terms of the lease agreement and are for a defined period. Freehold estates, on the other hand, involve ownership interests, like fee simple or life estates, that are for an indefinite duration. A freehold estate signifies ownership of the property, which the person leasing does not have. Therefore, a person operating a business on a leased property holds a leasehold estate, which is a type of less than freehold estate. Question 692. The following are sources of demand for mortgage funds, except A. Home construction. B. New business. C. Federal home loan banks. D. Land development. Correct answer is C. Federal home loan banks. Demand for mortgage funds comes from those who need to borrow money to finance real estate purchases or development. This includes individuals buying homes, developers building projects, and businesses acquiring property. Home construction creates a demand for mortgage funds as builders and potential homeowners seek financing for new residential properties. New business ventures often require financing to purchase or lease commercial real estate, thus contributing to the demand for mortgage funds. Land development projects necessitate significant capital, often obtained through mortgages, to finance the acquisition and improvement of land. Federal Home Loan Banks, FHL banks, on the other hand, are a source of funds for mortgage lenders. They are government-sponsored enterprises that provide liquidity to member financial institutions to support housing finance and community investment. Banks and other lenders borrow from FHL banks to have funds available to lend to those who demand mortgages. Therefore, while FHL banks play a crucial role in the mortgage market, they are a source of supply, not a direct source of demand for mortgage funds. Therefore, while FHL banks play a crucial role in the mortgage market, they are a source of supply, not a direct source of demand for mortgage funds. Question 693. When a sublease is made, the following occurs. A primary responsibility for paying the rent remains with the original tenant, sublessor. B. Primary responsibility for paying the rent is transferred to the new tenant, sublessee. C. The original lease is terminated by the sublease. D. Possession of the property is transferred to the lessor, but for less than the full term. Correct answer is A. Primary responsibility for paying the rent remains with the original tenant, sublessor. When a tenant, the sublessor, subleases a property to a new tenant, the sublessee, the original lease agreement between the landlord, lessor, and the original tenant remains in effect. The sublease creates a new, separate agreement between the original tenant and the sublessee. The original tenant is still obligated to pay rent to the landlord according to the terms of the original lease. The sublessee pays rent to the sublessor, who then uses those funds, hopefully, to pay the landlord. If the sublessee fails to pay the sublessor is still responsible to the landlord. While the sublessee pays rent to the sublessor, they do not have a direct contractual obligation to the original landlord. A sublease does not terminate the original lease. It creates a secondary lease agreement under the umbrella of the original one. A full assignment of the lease, with the landlord's consent, would typically be required to release the original tenant from their obligations. In a sublease, possession is transferred to the sublessee, not the original lessor, landlord. The sublessee has possession for a period that is less than or equal to the remaining term of the original lease. Question 694. In the wake of the widespread savings and loan failures of the 1980s, a law abolished the Federal Home Loan Bank Board and created the Office of Thrift Supervision to supervise savings institutions. The new law was called A. The Savings and Loan Rescue Act, SLRA. B. The Thrift Authority. C. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIREA. D. United States Savings Bank Central Command. Correct answer is C. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIREA. United States Savings Bank Central Command is not a recognized entity within the context of United States financial regulations or the savings and loan crisis of the 1980s. The Thrift Authority is a somewhat ambiguous term, as it isn't the official name of a single, specific entity. However, it most likely refers to the Office of Thrift Supervision, OTS. United States Savings Bank Central Command is not a recognized entity within the context of United States financial regulations or the savings and loan crisis of the 1980s. It sounds like a potentially fabricated or misunderstood term. There is no record of a federal agency or regulatory body with that specific name. In response to the 1980s savings and loan crisis, the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIREA, was enacted. This law eliminated the Federal Home Loan Bank Board and established the Office of Thrift Supervision to oversee savings institutions. FIREA was a comprehensive piece of legislation enacted to address the savings and loan crisis, overhaul the regulatory framework of the thrift industry, and restore public confidence in the financial system. It brought about significant changes, including the creation of new agencies and the strengthening of enforcement powers. Question 695. The following written instruments are contracts, except A. Mortgage, B. Exclusive authorization to sell listing, C. Escrow instructions, D. Quitclaim deed. Correct answer is D. Quitclaim deed. A contract is an agreement between two or more parties creating obligations that are enforceable or otherwise recognizable at law. It typically involves an offer, acceptance, and consideration, something of value exchanged. A mortgage is a contract between a borrower and a lender where the borrower pledges real property as security for a loan. It outlines the terms of the loan and the rights and responsibilities of both parties. Exclusive authorization to sell listing is a contract between a seller and a real estate broker. The seller agrees to give the broker the exclusive right to sell their property for a specified period, and the broker agrees to use their efforts to find a buyer. It outlines the commission and other terms of their agreement. Escrow instructions are written instructions signed by the buyer and seller, and sometimes the lender, that direct the escrow agent on how to handle the funds and documents necessary to close a real estate transaction. They create a contractual agreement outlining the obligations of the escrow agent. A quitclaim deed is a legal instrument used to transfer whatever interest the grantor, seller, has in a property to the grantee, buyer. However, it does not contain any warranties or promises about the quality of the title being transferred. The grantor is essentially saying, "Whatever I own, I give to you." It doesn't create obligations or promises in the same way a contract does. It's simply a conveyance of interest, if any exists. Therefore, a quitclaim deed is a conveyance instrument, not a contract that establishes ongoing obligations between parties.